Historically, central banks and governments around the world had always responded to a crisis by injecting more liquidity. And I thought that same thing would happen again. And I thought the US, because it had the biggest straw, would suck up all of that liquidity out of the global market into the US markets. And so while we have not had the sovereign debt crisis, although it looks like we may be headed towards one now, all of those things that I said I thought would happen kind of have happened. The dollar's higher than it was when I first started talking about it. Gold's higher than it was. U.S. assets went up dramatically from where they were then, and dramatically outperformed the rest of the world. Bonds have fallen. Interest rates have gone up, and so we've had some crises along the way, but we just haven't had the quote unquote big one yet.
On this episode of What the Finance podcast, I have the pleasure of welcoming on Brent Johnson. So Brent is the CEO of Santiago Capital, has 20 years experience in financial markets, and is well known for the creator of the Milkshake theory. So Brent, thanks so much for coming on the podcast today.
Thanks for having me. Should be a fun conversation. Lots going on.
Yeah, I'm sure we could talk for hours. Unfortunately, we're sort of limited here, but we'll try and get through it all. For any of the viewers who don't know, maybe we can start with the milkshake theory, because I know that sort of really shapes a lot of your thinking about the world and what's happening. So it might be a really good place to start, and then we can go into the craziness of the current world.
Sure, yeah. So listen, the milkshake theory is really just a very simplified and silly way for me to describe how I thought the future was going to play out in the markets. And I first started talking about this in 2018. And I thought that because of all the debt in the world, both in the United States and outside the United States, that we were likely headed to a sovereign debt crisis. And the reason I thought we would have a sovereign debt crisis is because interest rates were at zero. Due to the previous crisis, all the bad debts had been kicked up to the country balance sheets, the central bank balance sheets. And because interest rates were at zero, and I thought the 40-year bond bull market was coming to an end, when interest rates rose, I thought we would then have a sovereign debt crisis. And I said, as a result, I thought that bond prices would fall. I thought interest rates would go up. I thought interest rates going higher would actually make the dollar go higher, because as interest rates go higher in the US, it pulls capital into the dollar. And as the dollar went higher, that would then find its way into the US market, and US asset prices would go higher. And gold would go higher as well, because even though the dollar may be going up versus other foreign currencies, it might not necessarily be holding all its purchasing power. And so that was the milkshake, that part comes from, I thought, historically, central banks and governments around the world had always responded to a crisis by injecting more liquidity. And I thought that same thing would happen again. And I thought the US, because it had the biggest straw, would suck up all of that liquidity out of the global market into the US markets. And so while we have not had the sovereign debt crisis, although it looks like we may be headed towards one now, all of those things that I said I thought would happen kind of have happened. The dollar's higher than it was when I first started talking about it. Gold's higher than it was. U.S. assets went up dramatically from where they were then, and dramatically outperformed the rest of the world. Bonds have fallen. Interest rates have gone up. And so we've had some crises along the way, but we just haven't had the quote unquote big one yet. But the nice thing for me is it's a framework that has allowed me to stay invested, understand what's going on, make money for my clients, and not kind of be freaked out by everything that goes on. And every time a market goes up or down, you seem to get people getting overly dramatic, in my opinion. And having this framework has really kind of helped me navigate that volatility pretty well.
Yeah, and I've really, as you said, it's sort of almost played to a T the past couple of years. I really find it useful. What do you think led us to this point where we got to the stage where, a sovereign crisis is very hard to avoid? Was it just Fed being extremely low interest rates for too long? Was it, fiscal spending? Was it the 2008? What do you think caused it?
So I think that has contributed to it. But I think a mistake that a lot of people make, especially when it comes to the dollar, and I'm not saying this is you, but I'm just saying historically when I've interacted with people on this topic, is everybody wants to focus on the Fed in the United States, and for good reason. Listen, the Fed is the most important central bank in the world, and the U.S. market is the most biggest and most liquid market in the world. So you absolutely have to understand what's going on there. But I think they often do that to the exclusion of all the other markets around the world. And the simple fact is that when you zoom out and you look at the whole world, the U.S. has many problems, and the piper will be paid. But Europe has a lot of problems as well. Russia has a lot of problems. China has an incredible amount of problems. Japan has a lot of problems. Australia and Brazil have a lot of problems. And when you realize it's a relative game, and you realize that all of the other countries have a lot of the same problems and the debts that the United States has, but they don't have the advantages that the United States has, that's kind of what helped me kind of figure out the framework. But it's also all of the problems around the world, I think, are what is contributing to a crisis. If that's what we're going into now, I think it will be the combination of all of those things. I don't think you can lay the problem just at the feet of the Fed or just at the feet of the ECB or the Bank of Japan or the PBOC. I think it's a combination of the whole world getting too far in debt, and now the debt needs to be paid. And along with the debt getting so big is we have had extreme wealth inequality and standard of living within the individual domestic economies of all of these countries. And that wealth gap has caused political ramifications that are now being seen, with the election of populist candidates around the world. Trump is the main driver, but it's not just Trump. We see the same thing in Europe, or we see the same thing in England. We've seen the same thing, in other countries around the world. And this is a kind of a crash of all of these different forces: geopolitics, domestic politics, global debt dynamics, global demographic dynamics are all hitting the intersection at the same time. And so we have the potential for quite a dramatic event. Whether that happens or not, I don't know, but I think you have to be prepared for it.
Yeah, interesting. Do you think all the decisions, so say like China joining the WTO and all these other factors, is it all linked to this debt and the dollar, or do you think they've sort of just added to the trajectory of what's happening?
Well, I think China being allowed into the WTO, and then U.S. executives, if for lack of a better people to blame, outsourced all the jobs, all the manufacturing jobs overseas. And, that obviously contributed greatly to the inequality, because over the last, let's just call it 20 years, wages have been largely flat, but yet asset prices, home prices, cost of living prices have risen dramatically. So people with assets, people with stocks, people that own gold, people that owned a house already, they have done fairly well, if not great, because those asset prices have risen. But if you were a wage earner or someone on a fixed income and you didn't already have that pile of assets to, ride that wave, you've only gotten further and further behind. And the reality is people can be pushed for a long time, but eventually they're going to fight back. And I think that's largely what helped Trump get elected. But again, I would say you see the same thing in France with Macron and Le Pen. You see the same thing with Meloni getting elected in Italy. I know there's a lot of opposition to Starmer in England. And even in Canada, the Conservative Party was making great strides right up until Trump got elected and started taking shots at Canada, and that kind of put some wind in the sails of the Liberal Party again. But still, it's really kind of a global phenomenon, and I don't think that there's an easy way out of it.
Yeah, and it does seem to be more of a Western, and maybe that's just because a lot of them are, democratically elected, and so maybe that's why we hear more about it rather than the other countries. But it does seem to be more of a Western trend, at least.
Well, there's definitely a lot of Western fault here. I would say that I think in many ways China has it just as bad, if not worse, than many others. It maybe isn't as visible because things are more controlled. Like you say, it's not a democracy. Reporting is not as free as it is other places. But I think they have problems on their hand as well, because they have a demographic nightmare that they're dealing with. They have a real estate boom that has crashed, and they have an interesting quandary, because they moved a lot of very poor, uneducated citizenry from the rural areas into the cities to help for the labor to grow as much as they'd have over the last 20 years. And a lot of that hard work that was done by those people was predicated on the idea was, you put this hard in work now, it's all going to be worth it down the road when when China becomes the next global power. And as long as everything was going up and everything was fine and people were making money on the houses they were buying and the real estate they were buying and their jobs were secure, everybody was happy. But, in the last several years, that trend has changed, and China's growth is no longer what it was. The real estate market has collapsed. The stock market has gone down dramatically. There's been a number of layoffs. The unemployment rate has risen. And so as a result, there's a lot of internal tension in China that's kind of simmering right below the surface. And I don't think you can say that the inequality only exists in America or in Western Europe. I think, listen, there's a lot of guilt to be placed there. I'm not absolving them of problems, but I don't think the sins of the West forgive the sins of China, and I think everybody's going to have to pay the price.
Yeah, it's a great point. Do you see it then as a misallocation of capital by many of these economies over the past 20, 30 years, or is that just an oversimplification?
I wouldn't say it was a misallocation, because they all made a lot of money by allocating assets to those places. So it's hard to say they were wrong for doing it when they made money doing it. However, the pendulum can only swing so far before the energy to keep it going in that direction is gone, and then it starts to swing back the other direction. And now that it's swinging back the other direction, I think it would take an incredible amount of energy to get it going back in the positive direction again. So I think the pendulum is going to swing to the other way. And it won't be in a straight line. Markets never move in straight lines. There's always starts and stops. But I think largely now the pendulum is swinging the other way. And I think whereas for much of the last 25 years, maybe not the last 5 years, but from 2000 to 2020, I would say the world largely worked together, cooperated, moved towards globalization. There was one supply chain. It was kind of the golden age of travel. You could pretty much go anywhere in the world you wanted as long as you had a passport and the money to do so. But since COVID, the pendulum has started swinging the other way. The world is no longer cooperating the way it was. Not only are they not cooperating with each other, but they're actively hostile towards each other. And so I think if another crisis were to come up, I don't think it would be dealt with in a cooperative and coordinated manner like the previous ones have been. And that's why I think the next one could be a little more volatile and could last a little bit longer than they previously have. And, going back to the misallocation, the idea of the whole milkshake was that after the world mixes the milkshake coming out of the crisis, all of that capital gets sucked up into the United States. And that largely happened. What you're seeing now is typically when a crisis starts, that capital that has flowed into the United States initially gets sold and repatriated back, because the U.S. has sort of become the piggy bank for the rest of the world. The rest of the world invests in America because America has been the dominant market and the dominant growth area, especially since COVID. And so when things start to go south and things start to slow down, people have to tap their piggy bank. And that's what's happening now. What historically has happened is that if it continues to get worse after that initial tapping of the piggy bank, if it continues to get worse, then the dollar tends to do very well. So all the dynamics that are playing out right now are kind of scarily similar to 2007. September of 2007 saw a very similar episode to what we've seen over the last month. And February of 2020 saw a very similar dynamic to what we have seen over the last month. Now, in both of those previous cases, as things continued to get worse, money started flowing back into the dollar and the U.S. safe haven. That has not materialized yet this time, and perhaps it won't. But if history is a guide, that's typically what happens. And the reason that capital typically ends up flowing back into the dollar is because the whole world, non-US, the whole non-US world, in addition to using their local currencies, they also use the dollar to interact with each other. That's called the euro dollar market. And I think a lot of people are maybe not familiar with the euro dollar market, but the euro dollar market, again, the dollar market outside the United States is bigger than the dollar market inside the United States. And I think a lot of people are familiar with the fact that the US owes over $30 trillion in the domestic market. But I don't think people realize that the rest of the world owes even more than that to each other. They don't owe it to the United States. They owe it to each other in this euro dollar market. And that's with a currency that they can't print. Historically, the Fed has bailed them out. But now with Trump being in the presidency and his mandate for America first, I'm not sure that those bailouts to the rest of the world will come as quickly and easily as they have in the past. And so that's another reason why I think this time has the potential, at least, to be a little bit more scary and prolonged than the last few crises have seen. The last few crises we've had, have been relatively short-lived. They were perhaps dramatic and very scary, but they passed fairly quickly. I'm not sure that this next one is going to pass as quickly as the previous ones.
But then that'd be a power decision, wouldn't it? Because I think the Fed have control over the swap lines. Is that correct?
That's absolutely right. And so, historically, the reason swap lines have been used is because I don't want to get too far in the weeds here, but we live in a debt-based monetary system, which means all the money that exists has been loaned into existence, with the exception of the base money. So the base money is the physical coins and currency of US dollars and the reserves at the Fed. So that's considered base money. All the other money in existence has been loaned into existence. And typically when we've gotten into a downturn, the Fed has gone in and recapitalized the system by putting new bank reserves, base money, into the system. And that signal that the Fed is going to be there to bail everybody out then gets everybody else to go back to spending and extending credit and doing what they were doing before. And then the system kind of self-perpetuates. But the rest of the world does not have a Fed that can create dollar-based money to get the system going again. So that's why the swap lines exist. The swap lines exist as a way for the Fed to get those dollars to the ECB, to the Bank of England, to the Bank of Japan, et cetera, et cetera. I just don't think that those bailouts or those swap lines, I'm not saying they won't be extended. I think they probably will be extended, but I think they will have tighter strings attached to them than they had in the past. And I think in some cases they won't be extended at all unless you agree to a new tariff deal or a new trade deal or a new military alliance. And so with Trump coming in and kind of changing the way that the U.S. does business, I just think it's going to be a different game this time. And that, again, causes great problems to the rest of the world because, they owe that money to each other. So if they default on that U.S. dollar debt, they're not defaulting on the United States. It's Turkey defaulting on France, or it's Indonesia defaulting on Japan, or it's Australia defaulting on India, or whatever the one is, right? And so if the U.S. doesn't come in and help recapitalize those systems as the credit contraction picks up speed, then that's how you get not only a credit contraction, but a potential credit collapse.
But then I guess the private banks in those countries can create dollar debt, but then they need, but then they still need some dollar assets for it to keep circling. Is that correct?
That's exactly right. So those banks outside the United States, they can continue to extend US dollar credit, but they have to do so by risking their own balance sheet. And in a credit contraction, that's the opposite of creating new loans, right? And in a credit contraction, they often don't want to make new loans because the loans currently on their books are already going bad. So it's tough to make a new loan when the loans that are currently on your books are starting to explode or implode. And so, yes, if the system starts extending credit again and you get a jump start to the economy, then those private banks can do that. But historically, the reason those private banks have done that is because the local central banks have gotten dollars from the Fed via swap lines. So those local central banks get the dollars via swap lines, and then they loan those out to their member banks. And then those member banks use that as collateral to extend new loans. But if that new collateral isn't extended to them, it's hard for them to further risk their balance sheet. And so that, again, it's going to be interesting to see how this goes, because I'm not saying the Fed won't provide the support. I just don't think it will come in with the same ease and process that it has previously.
Yeah, really interesting. And maybe I would love to go in this direction, but maybe we can take a step back and just, analyze what are you currently seeing? Obviously, there's tariffs, there's lots of stuff happening. What are you currently seeing in the economy?
Well, obviously, it's you got to the euro dollar market. This euro dollar market that I've explained is the key to it all. And the fact is, the rest of the world uses dollars to operate on the global stage. And part of the reason Trump's tariffs are so scary, I'll just use that as a simple word, is because tariffs mean fewer dollars are going to be flowing out into the rest of the world. If fewer dollars are flowing out into the rest of the world, that means the supply of dollars out there in the rest of the world is constricted, or it's not as prevalent as it was before. But all of that US dollar debt still has to be serviced and paid off. And so if these countries and these corporations outside the United States have, in their revenue models and in the debt that they've taken on, they've forecasted a certain amount of revenue they get from selling stuff into the United States. And all of a sudden, that revenue coming in from the United States gets cut in half, or even by 20 or 30%, that dramatically affects their income statement due to all the debt that they have. And so the big companies who have prepared for this and have sufficient cash flows should be fine. But, part of the reason that we're getting into these crises in the first place is because corporations and countries have taken on a lot of debt, and they are not prepared for this. And so as the fewer dollars flow into the rest of the world, it causes problems. Now, I think, again, what we're seeing recently is the dollar falling. The dollar's fallen pretty significantly over the last 3 weeks. And if it continues, then that actually I actually don't worry about the dollar going lower. If the dollar goes lower, that kind of signals that there's plenty of credit being extended. And if plenty of credit is being extended, we should not have an existential crisis. I'm not saying it's impossible, it's just low probability. I get more worried if the dollar goes higher, because that means that the supply is contracting. But if these tariffs lead to fewer dollars circulating in the rest of the system, eventually that's going to cause a supply crunch for the rest of the world, who needs these dollars to fund their economies, to buy energy, to pay off the existing loans, to pay off, the invoices that they've taken on from their suppliers. And it becomes a little bit of it becomes a currency crisis, quite honestly. And we saw shades of this in 2022. As the dollar went higher in 2022, England got into fiscal trouble, Europe got into fiscal trouble, Japan got into fiscal trouble. That's when China's downturn kind of precipitously picked up. And so that was a real life example of, because the Fed was raising interest rates, it meant fewer dollars were flowing into the rest of the world, and we saw the ramifications. In many ways, tariffs are kind of like a rate hike. They're not implemented the exact same way, but it ultimately means fewer dollars flowing around into the rest of the world. So this is a long way of saying, if the dollar's falling, that's actually a pretty good thing for people, because the dollar falling is typically not a crisis. What typically causes a crisis is when dollars cannot be sourced and the price rises because there's a supply constraint.
Okay, really interesting. And could the recent dollar decrease be due to also maybe these foreign assets selling, foreign investors selling their assets to try and repatriate the dollars to their
absolutely.
Country? Yeah, so that could be another option rather than credit.
That's absolutely that is absolutely what's happening right now. And the reason it's happening right now is because it's not just the U.S. markets that are under pressure. European markets are down like 10% over the last month. Chinese markets are down 10% over the last month. Hong Kong's down. Japan's down. The tariffs have definitely hit in the United States, but it's not like they've hit the United States in isolation. Kind of the whole world is under pressure. And when you come under pressure, what do? You tap your piggy bank. That piggy bank has been the US. So there's no doubt they're selling their US assets, they're getting dollars. They're taking their dollars, they're selling those and buying their local currency, and that gets sent back home. So there's no question. And they're also doing that because of Trump. Trump, they just don't know what Trump is going to do next. They don't know what kind of policy he's going to put in place. They don't know what kind of demands he's going to make. So what do you do in uncertainty? You put some of your reserves on the sideline just to be ready. You have that dry powder. And not only that, but countries around the world are starting to realize that the US isn't going to pay for everything either. They're going to have to pay for some of it themselves. And so as a result, those countries are going to have to implement capital controls. They are going to have to probably cut interest rates. We're already seeing that in Europe. We're already seeing it in other countries. And they'll probably have to go back to QE at some point. Not only will they have to cut rates, they'll probably have to go back to QE. So especially in Europe, where not only are they going to have to deal with the tariffs, but they're going to have to deal with funding NATO to a greater extent than they currently have, and paying for a war that's on their border. So there's a lot of challenges going on in the rest of the world, which is part of the reason they're repatriating the capital back, and it obviously with the uncertainty that Trump is creating.
Okay, but then as you're saying, you see this to be, there's going to be a risk in the future where there's just going to be a dollar shortage, and could be negotiating power. You hope that it's be able to resolve, but it does sound like it could be extremely negative.
Yeah, my guess is that, my base case is that we're not going into a recession, which I know sounds kind of crazy because everybody else thinks we're going to have a recession now. But my base case is not that we're going to have one, although I'm prepared for one. But my guess is that perhaps in the second half of the year, I do think we're going to see more downside in the markets in the next probably 3 to 6 months. But I kind of think as we get into the second half of the year, perhaps it won't be as bad as initially thought, or perhaps by that time, the Fed will be in easing mode. Maybe it'll even be doing QE. Maybe Japan will be easing again by that point. Maybe China will come through with this big stimulus that they're finally having to do. Maybe the Bank of England and the European Central Bank will be back to QE by that point. And again, QE and the injection of new liquidity and the bailouts and the stimulus, that's the milkshake. And in that environment, I would expect the capital that's free to do so, that isn't locked down due to capital controls, I would expect to, again, flow back to the United States. And if it does not flow back, then I would expect the US to provide stimulus that stays in the United States. And so that could push asset prices higher. So I think what we're seeing now is kind of the movie trailer for the movie that comes over the next 2 or 3 years, if that makes sense. This is kind of the warm-up act. We're getting a signal of what could potentially happen. But I think a lot of people are too quickly writing off the United States and writing off the US dollar and thinking that the end game is here now in the next 6 months. And I just think it's going to take another 3, 4, 5, 6 years to fully play out. And perhaps longer than that.
Yeah, no, it's a really great way to put it. So I think you've talked about before the realignment of the world order, and I guess that's what you're saying before, that it's this. And I think you mentioned it, where it's a shift against everyone's working together, everyone's working for the greater good or whatever that is. And now it's very much a focus myself, focus on them, focus on that. So yeah, how are you seeing that?
Yeah, so I'll actually give a shameless plug here, because I've been writing about this quite a bit on our Substack. So if anybody's interested in the stuff that I'm talking about here, or even what I say next, if you go to santiagocapital.substack.com, you'll see some of our writings there. But essentially what's going on is a dismantling of the rules-based order that was put in place post-World War II. So post-World War II, the Allied powers got together. They actually got together before World War II, but they officialized it after World War II, and they set up the new global order. And there was a way that the world would work together. And they used the United Nations and the World Bank and the International Monetary Fund and the global central banks and the capitals and the state departments. But there was a system in place of how things, the World Trade Organization, there was a way to do things. And it was often done on a multilateral basis where, you would have one group of countries, negotiating with another group of countries, but it was typically not done ad hoc and unilaterally by one country. But what Trump has come in and said, no, we're not doing that anymore. We are no longer doing these multilateral deals and where the United States ends up subsidizing somebody else and paying for somebody else. From now on, we are not going to do anything that is not 100% in the U.S. best interest. If it's not in our interest, we're not doing it, regardless of what the treaties say. Now, even under the best of circumstances, if someone were to do that, and you have to remember that he's trying to completely change the revenue model of the United States from one where the internal citizens pay all the taxes to an external revenue where countries selling goods in the United States pay the revenue to the United States. So I think even under the best case scenario, if you're trying to dismantle the rules-based order and put things in unilaterally, while also trying to change the way the biggest market in the world does business and completely change its revenue model, under the best of circumstances, I think that would be extremely challenging. There would likely be volatility and definitely some unintended consequences. And I think that's exactly what we're seeing, because I don't think we have the best of circumstances. In fact, I know we don't have the best of circumstances. And I think, in fact, we have very challenging circumstances. So to try to pull this all off in a very challenging environment, I think there's no question going to be absolute volatility. But having said that, I'm not convinced that the U.S. comes out of this worse off than they went into it. Maybe they will. I can't say that they won't, but I think there's a lot of analysts and different people that I talk to and listen to who just automatically assume that there's no way this is going to work and it's only going to end in disaster. And I'm just not convinced that that's the case. I'm prepared for it, but I'm not convinced that's the case.
And who is the loser? Is it China? Because I guess if I think about, and I think I've heard you say this before, and I had a similar idea where it's like you look at the tariffs, you look at who was the real target. They did a blanket tariff on everyone, but it really seemed that China was the real target, and they're the only ones who have had it escalated. Do you think they're the largest loser?
Well, sort of. So let me qualify this. And this is probably a good time for me to say this, because I typically say this at the early on in one of these interviews, especially for an audience that I have not spoken to before. Whenever I talk about this stuff, this has nothing to do with what I want to see happen. I as much as I possibly can, I remove my own wants and desires out of this and just try to be hardcore objective to see what's actually going to happen, whether I want it to or not. Okay. So with that caveat, I think all of the tariffs, all of the new policies, all of the new mandates, or however you want to describe what Trump is doing, I think all of it is geared towards keeping the United States on top and keeping China from ascending to the top. So I think it's all about China. And it's 99% about China, right? And so I think if other countries align with the U.S., they will be better off than if they align with China. But that's what's happening. Sides are being chosen. And the U.S. is kind of mandating that you choose sides. And I would expect that for those who align with the U.S., they'll be treated very well. And I would expect those who do not align with the U.S. will be treated very badly. Because I do think it's all kind of geared towards China. Now, having said that, I think the potentially biggest loser is Europe. And what I mean by that is, I think the U.S. could largely be self-sufficient if it had to be. I'm not saying it would be easy, and I'm not saying it can happen overnight. I'm just saying on a relative basis, I think it could do pretty well. And I think China, if they wanted to, China could just lock down its borders, go back to being a domestic kind of hermit kingdom in the East and, do their thing. But I think in this picking of sides, I think Europe probably comes out the worst, because if they choose to go with the United States The United States, I don't think, is going to treat them great. Maybe it'll treat them better than that China would treat them, but I don't think it'll treat them great. And I think we've already seen industry leaving Europe and coming to the United States. We already see the debts in Europe are just as bad as the debts in the United States. The growth in Europe is anemic. They have as many social problems in Europe as they have in the United States. And I kind of feel like there's these big power plays between, the United States, Russia, and China. And I kind of feel like Europe's a little bit kind of forgotten. Now, I know there's a lot of Europeans who don't like hearing me say this, and there's nothing personal against Europe, but I think Europe is going to have a really challenging time.
Yeah, it is a challenge when they've hedged their bets, and as you said, they have high exposure to both countries, so there's not really, either way you're sort of at a loss. But how does this sort of affect your investment approach?
Well, I should a couple ways. We have been expecting this for a long time. So we've actually had, despite the dollar going down, we've had a great year so far. And part of the reason we've had a great year is we understood what Trump's policies would be, and we understood the damage that Trump's policies would have, at least initially. Now, again, I want to say, I'm not convinced that Trump's policies will be bad medium to long term, but I know the kind of volatility that they'll cause short term. And so we came into the year extremely cautious and expecting a lot of volatility and a lot of downside in markets, and that has happened. And we weren't surprised by the dollar falling because again, this is the same dynamic has happened before. If the dollar were to continue to fall in a big way, it wouldn't be shocking, but it would be surprising. And so I think the people who think that because of what's happening, the U.S. is automatically going to lose, and as a result, reallocating their assets back to Europe, back to China, back to Japan, I'm not sure that's the right play. So what we have been doing is we have a lot of cash on the sidelines. We had a lot of hedges on our equity positions, but we still own equities. We have diversified portfolios, and we own short-term T-bills. We own U.S. stocks. We own gold. We have various exposures to some private equity and, some other real assets. But in general, we have fairly conservative portfolios. And the reason that we're not sitting 100% in cash is as if you zoom out and you look at markets over the last 100 years, they tend to go up and to the right. And the reason they tend to go up and to the right is because fiat currency loses value over time, and because central banks and governments typically, when a crisis hits, tend to bail the markets out and provide more stimulus. So sitting just in cash and doing nothing, we don't think is the right thing to do. But we also know, because it's a debt-based monetary system, and because the debt can only go so far before you get a contraction and a severe drawdown, we always have some kind of a hedge or some kind of a downside protection or some kind of a tail risk strategy on our portfolios to protect us if that happens. And we're still doing the same thing. We don't have as many hedges right now as we did at the beginning of the year because those hedges have largely already paid off. Now, if we have more downside, we still have some, and we can be tactical on the way. But we are, we're not as worried right now as we were 3 months ago. Is probably the right way to say it. My guess is that we are going to have more downside into Q2 and Q3. But I think kind of by Q3, Q4, we're probably going to have an opportunity to get more aggressive and perhaps get some more upside. Now, whether that's because things get better or it's because governments bail the markets out again, I don't know. And if I'm wrong, I can pivot and adjust at the time. But that's kind of the way we're seeing things right now.
Yeah, great. Really interesting to see how you you use it for your own approach. So, Brent, thanks so much for your time. We've sort of gone in all different directions.
No problem.
Yeah, I really enjoyed it. But my last question is, what is one message you want people to take away from our conversation?
I think the best thing to take away is don't be dogmatic about anything. I completely understand those who are in crypto because they think the system is rigged and that's their only opportunity to make, gains to catch up with all the bad things that have happened. I completely understand the people who are in gold because they think fiat is dying and you need to have exposure to real assets because it's only a matter of time before the fiat system collapses. I completely understand the traditional market people who think the gold people and the crypto people are crazy, because in many ways they're as dogmatic as the Keynesian, MMTers. And the thing that I would say is there's something to learn and understand from all of these different groups. And in 25 years of doing this, I have found that nobody is always right and that nobody is always wrong. And the most important thing is just to understand what's happening and have situational awareness, and not be too firmly planted in one camp or the other. And that's probably a good way of saying be diversified, be conservative, be flexible, and don't be too rigid in whatever your portfolio approach is.
Yeah, it's a really great message to take away. So Brent, thanks again. If anyone wanted to find out more about your work, I know you mentioned the Substack. Is there anywhere else people could find what you do?
Well, if you go to santiagocapital.com, there's my contact information. That's for my wealth management business. I mentioned the santiago.substack.com is where we do a lot of our writing. We have a premium service under the Macro Alchemist brand. If you go to macroalchemist.com, that's a premium research service. And then every week we do a show called Milkshakes, Markets, and Madness on YouTube, where we just kind of talk about what's going on. So there's lots of different ways, and I'm pretty active on Twitter, just Santiago Capital. So, if anybody's interested in the stuff we talked about there's multiple ways to find out what we're doing and interact with us.
Yeah, great. I'd be surprised if anyone hasn't seen what you do, because I think it's very valuable and it always gets suggested. So people are resonating with it. But
I appreciate you having me on. Thank you.
Yeah, thanks again, Brent. Look forward to doing this again in the future.
All right.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.